Takes us to our talk of the tape, whether the fourth quarter will deliver better for investors, as history suggests it often does, or is this year's hill just too steep to climb? Let's ask Cameron Dawson, Chief Investment Officer at NewEdge Wealth. She's here with me at Post 9. Nice to see you.
Good to see you.
First thing you said when you sat down, utilities. Wow, right? It's pretty stunning to see a sector move to that degree.
It is incredibly stunning. And of course, there is that yield impact. If you look at the utility sector, it now has a dividend yield of an entire 100 basis points less than the 10-year Treasury. So why take on the risk of compliance and regulation and climate in utilities when you could just buy the 10-year Treasury? It does raise the question, though, if what we're seeing within the technology side of things, those names where people flock to saying they're a bit more defensive, is that why we're seeing so much strength in those mega caps as people leave the other high-yielding defensives away and go into those? It
is interesting, too, because you could easily understand if, let's say, we're saying, okay, the 10-year hits 470, it's a cycle high. Well, obviously, growth is going to be down.
Yeah.
Not so much today, though. Is that what you think it is? Money coming out of places like utilities and just going for perceived safety or more defensive, again, out of staples too.
Yeah.
And into what is perceived to be these more defensive areas like mega cap tech?
It certainly feels like that. And I think because mega cap tech has also had a lot of earnings resilience, not just in the past couple of years, but if you look over the last cycle, tech has had actually better downside performance in recessions in its earnings than even utilities did. The problem with it is that you can't pay any price for defensiveness or for safety or for quality. And the question is, if you see these valuations continue to expand as the only game in town, do you run right into having those very high interest rates put pressure on those valuations? And kind of what degree of resilience are you already pricing in?
How are you feeling about yields? You feeling we're nearing a top? It was such a swift rise in September. The market obviously was unsettled as a result of all of that. Feeling toppy now? What do you think?
I think from a technical perspective, yields are overbought or bonds are oversold. We've seen this move be near parabolic, which means that you could see some digestion that could provide some relief in this fourth quarter. But I think if we're looking at the trend in yields, it still is very resoundingly positive to the upside. And then if we think about the fundamental dynamics, you still have this scenario where supply is coming in much higher than expected because of higher deficits. And there's just not the demand for that safety trade yet from the market. If you think about demand coming from people worried about a recession, data comes in better than expected, you're not seeing that same kind of flock to safety that could buoy yields.
Let's talk about valuations, whether they're too expensive or not. I'm looking at a headline right here from Marko Kolanovic, J.P. Morgan. He's been negative for a while, and when he publishes a note, we bring it to our viewers. And I want to do it again now. Quote, "Our cautious outlook will likely remain in place as long as interest rates remain deeply restrictive, valuations expensive, and the overhang of geopolitical risks persists." Valuation, the multiple on the market, price relative to earnings. Is it too rich or not?
I think it is too rich, and we've been thinking about how we hit a ceiling effectively at the end of July, where the forward valuation traded up to 20 times earnings. Tech got up to its prior high from 2021 in its valuation, which was very, very rich. We've seen that come off some. You're now up about a turn above long-run average, but given where we are in interest rates, it's likely to say that you could see even more come out of the valuations, mostly in those growthy side of things, if you start to see a shift to more risk-off type of positioning and that risk aversion come back to the market.